Cryptocurrencies emerged as decentralized digital assets promising financial inclusion and autonomy. However, their anonymous, borderless nature has attracted illicit finance uses, including money laundering, drug trafficking on dark web marketplaces, ransomware payments, and terrorism financing. Criminals can convert stolen or illicit funds into crypto, move them across jurisdictions, and obscure transaction trails. This dual-use characteristic sparks a debate on whether governments should ban or heavily tax crypto to curb its darker side. Proponents of bans or steep taxes argue they would raise the cost and risk of using crypto for wrongdoing. Ransomware attackers consistently demand cryptocurrencies for their high value and pseudonymity, a model that could collapse if transactions faced punitive levies or outright prohibition. Dark web vendors similarly rely on Bitcoin's uncensorable rails to evade law enforcement, so financial disincentives might choke off these illegal marketplaces. As regulators grow more uneasy about financial stability and public safety risks linked to crypto, heavy fiscal measures appear an attractive blunt instrument. Yet an outright ban or oppressive taxation risks collateral damage to legitimate innovation and financial freedom. Governments from the US to Europe are instead pursuing regulatory clarity through frameworks like the Genius, Clarity, and Stable Acts, which aim to define oversight, consumer protections, and issuer obligations for digital assets. By transferring jurisdiction to existing financial agencies, these measures seek to integrate crypto into the financial system with guardrails rather than drive it underground. A blanket ban would sidestep these efforts and push users toward unregulated, offshore platforms. A more targeted strategy combines anti-money laundering and know-your-customer rules with licensing regimes for exchanges, enhanced blockchain analytics, and public-private information sharing to trace illicit flows. Policymakers can also require stablecoin issuers to hold transparent reserves and adhere to digital asset market clarity rules. Grounding crypto policy in principles of fairness, safety, and accountability ensures that measures focus on malicious actors without undermining consumer demand or the macroeconomic potential of digital currencies. This calibrated approach leverages tools that have curbed traditional money laundering while preserving innovation. In balancing the promise and peril of cryptocurrencies, governments face a choice between blunt prohibition and calibrated oversight. Bans or steep taxes could reduce illicit transactions but risk stifling legitimate uses and encouraging shadow markets. Conversely, a nuanced regulatory framework bolstered by targeted enforcement can mitigate financial crime without sacrificing the innovation and inclusion benefits crypto offers. Ultimately, refining legal standards and enforcement capacity, rather than punitive taxation or wholesale bans, appears the most sustainable path to curb illicit finance while harnessing the potential of digital assets.